BlackRock's Most Wanted Investments 2023 predictions. With $10 trillion in assets under management as of January 2022, BlackRock has more assets under management than America's top 3 banks, JP Morgan Chase, Bank of America, and Citigroup Inc., who manage a combined total of approximately $9.2 trillion in assets. Welcome to today's video. We will look at BlackRock's 2023 predictions and where they will invest. We will give you BlackRock's biggest buys. Is it Apple, Tesla, Google, or Walmart? The assets it has sold the most, and why it is likely to continue holding others. 2022 was characterized by geopolitical tensions and quantitative tightening as central banks, including the Federal Reserve, increased interest rates. With that in mind, BlackRock's 2023 investment theme will be guided by 3 factors. 1. Pricing the damage. 2. Rethinking bonds. 3. Living with inflation. Remember that in 2019, BlackRock published a report that correctly predicted the policy shift toward monetary easing, which influenced how the markets behaved. BlackRock's investment play in 2023 will be a reflection of market sentiment and reality. This is highlighted in their report, in which they will change their investment perspective based on market conditions. In essence, BlackRock will turn bullish when the market outlook turns positive. BlackRock's portfolio changes will be determined by the following factors: market sentiment, market pricing of the economic damage. BlackRock is already at its most defensive stance. This means that the giant asset manager doesn't think that the market sentiment has turned positive or that the damage is fully reflected in the market. Let's take a closer look at the 3 factors mentioned earlier. Pricing the damage. A recession may be on the cards as central banks fight off inflation. Economists are predicting a 70% probability that a recession may be on the way. The incoming recession is different because it is intentional. Raising interest rates makes borrowing very expensive. The demand for goods and services takes a knock, and companies may be forced to lay off workers or stop hiring. The damage of the impending recession can already be seen. Increasing mortgage rates have tanked home sales. Experts have sounded alarm bells by warning that the U.S. housing market is in trouble. Europe is also feeling the pinch through energy shocks, which are worsened by tightening financial conditions. In the end, the economic damage will be determined by how far the central banks are willing to go to rein in inflation. The harder the central banks go, the larger the damage to the economy. Fed Chair Jerome Powell has indicated that more rate hikes could be on the way in 2023. However, inflation has shown signs of slowing down. High inflation is a leading driver for the Fed to hike rates. When inflation starts lowering, the Fed is inclined to pause or pivot. On the same note, BlackRock expects central banks to stop hiking. For this reason, BlackRock is standing ready to turn positive if market conditions improve, although for now, it's still reducing equities. Rethinking bonds. Fixed income has become attractive after yields increased globally. This has made bonds more appealing to investors. BlackRock will be capitalizing on this in a granular investment manner. A granular portfolio is highly diversified and consists of several holdings. Investment-grade credit also is appealing to BlackRock and is what the world's largest manager is leaning towards. Investment-grade credit is a fancy way of saying there is a low risk of defaulting. The reason why it's so appealing to BlackRock is that investment-grade credit can perform well even in a recession. This is because companies have strengthened their balance sheets by refinancing debt at lower yields. Investment-grade credit presents a low risk of credit default. BlackRock has different views when it comes to government bonds. It finds short-term government bonds attractive while it stays away from them in the long term. The belief is that there is a strong correlation between stocks and bonds. This means that when stocks fall, bonds will also do the same. This is because central banks may not be quick to cut rates during a recession they engineered. Rates may even stay higher. BlackRock says that the central banks will not pivot anytime soon. This could lead stocks to take a hit. Living with inflation. High inflation has seen a surge in the cost of living. This has forced central banks' hands to vigorously fight inflation through persistent interest rate hikes. This fight has resulted in the loss of jobs and a compromise on economic growth. BlackRock thinks that the markets have not yet fully priced in inflation. BlackRock will continue to have a large size on inflation-linked bonds and real assets such as precious metals and real estate. Where we are now. From BlackRock's perspective, the damage has not been priced in and the market sentiment has not yet turned positive. Therefore, the asset manager has taken a defensive stance as it favors credit and short-term government bonds over equities and long-term government bonds. With this being said, BlackRock's position is that 2023 will be a risk-off. A risk-off environment sees investors putting their money in safer investments such as bonds or gold. A risk-on is when investors are more interested in riskier assets such as stocks. In the long term, BlackRock anticipates increased volatility in the markets. The solution for the asset manager is diversifying its approach and creating a recession and inflation-proof portfolio. Despite reducing holdings on U.S. and European equities, BlackRock will prefer some sectors over others. The asset manager finds the energy, financials, and healthcare sectors attractive, while downvoting sectors such as staples and utilities. How BlackRock rates equities in different countries. BlackRock has invested in equities in the United States, Europe, China, Japan, and emerging markets, and has either sold, held, or added more of the stocks depending on its view of the asset in question. BlackRock is reducing holdings on equities in emerging markets because their earnings do not take into account the incoming recession. On U.S. equities, BlackRock is holding less because the Fed may not be done with raising interest rates. The Fed's monetary tightening will likely continue to have the same effects as it did in 2022. The stock market cratered in 2022 due to a tightened approach. Wall Street ended 2022 with the largest annual drop since 2008 when the world's economy plunged into a recession. Healthcare, industrials, and financials saw the lowest drops, while communication services and consumer discretionary suffered the biggest losses. This could explain why BlackRock favors some sectors over others. BlackRock will be holding less European stocks due to rising energy prices and the risk of stagflation brought by tight monetary policy. Stagflation is a period characterized by high unemployment, rising inflation, and a stagnant economy. BlackRock will also be reducing UK equities because the valuations are much higher compared to those of other developed nations. The UK equities will likely sell off so that their valuations are in line with other developed nations. Japan has an easy monetary policy in which it lowers interest rates, and this is the reason why the asset manager is holding Japanese equities. Japan was one of the few countries pursuing a loose monetary policy while other central banks were tightening. The Asian country has a debt of $9.6 trillion US dollars, and if it attempts to tighten its monetary policy, it will leave the government and businesses in a difficult position. BlackRock takes a similar position on holding Chinese equities. Although activity is starting, BlackRock foresees lower growth in China due to the state's tight control of the economy, which renders the country's assets risky. China controls its monetary policy through several measures, such as currency printing and controlling forex rates. Why BlackRock's asset allocation is important. BlackRock's position on financial instruments is important to know because it gives an idea of market behavior and direction. The asset manager is taking a dynamic position with a view on both short-term and long-term investments, from being underweight on equities to being overweight on short-term government bonds. BlackRock's action in the next 6 months to 1 year can give investors an indication of what they can expect from the market. 2022 was a difficult year for investors as the financial markets tumbled. There is a possibility of a reversal in 2023, but it is no certain way. BlackRock is keeping its eye on the possibility of continued high inflation and, by extension, high interest rates. The hikes will be a necessity in curbing inflation, and this will lead to slower growth in the economy. The high interest rates make investment-grade credit an attractive choice for investors, while equities will likely take a backseat. BlackRock is taking a weighted and cautious approach due to the market conditions. However, when the damage is priced in and the market turns risk on, BlackRock will go all in on equities while taking a measured approach in government bonds and investment-grade credit. At the moment, the market conditions favor short-term government bonds. BlackRock's position is that what worked in the past will likely not work this time around. It is time for a new approach.